Welcome, everyone. Thank you for joining us on this beautiful day at the Bloomberg Sustainable Business Summit. We're here to talk about physical climate risk, a ticking economic time bomb. We were definitely trying to get your attention with that title. I'm joined here by Nicole, Anil, and Ahmad. We'll go ahead and jump straight into it. Physical climate risk, especially in 2023. We've heard every superlative in the language being used to describe the frequency and intensity of different events that have been happening across the world, like especially when it comes to flooding, right? I think there was like a 10-day window in September where we saw 12 different countries and territories being hit by flooding. There was like Libya and Hong Kong and Greece and Brazil and New York. So I'll start with you, Nicole. From your view of climate and sustainability in financial institutions, how do you see the extent of these climate perils being factored into climate disclosures today, like TCFD, for instance?
Yeah. Look, so I think the headline answer on this is that there's still quite a disconnect between the reality on the ground in terms of the physical risks businesses and individuals and other real assets are facing and what you're seeing show up in TCFD-aligned disclosures. Just to give you some data to support that statement, we've been doing a lot of research on this over the recent months, looked at a really large set, about 5,000 CDP disclosures from 2022. If you look at and scan across that set, across corporates and FIs, you see roughly 80% of companies recognize that physical climate risk is a material issue, right? The disconnect is actually in the measurement of the impact and then the kind of the level of the quantification. So of that 80%, you see only about 50% who are actually attempting to quantify that impact. And then of that subset, it's like 2/3 who are quantifying an impact that is quite small relative to the size of the business, something like less than 5% of revenues. If you contrast that with then what we're kind of hearing on the ground with all of our clients across industries and sectors, you feel that companies do recognize that these risks are real, right? So there's a sense of, look, I know this is a thing I need to be thinking about. It's affecting my business. I'm seeing it affecting other people's businesses. But I'm not sure I'm quantifying all of that yet, right? So that I think that's the inherent nature of the disconnect we're seeing.
Absolutely. And just as a reminder to everyone, in case you have any questions for our panelists as well, we'll be taking that at the end of the panel, so please feel free to use the QR code. But just bouncing off of what you just mentioned, Nicole and Anil, since you're representing one of the world's largest reinsurers, Swiss Re here, how do you see this gap between reported losses, economic losses versus insured losses?
Yeah, no, thanks, Dharrini. I mean, I think that's an interesting dynamic, right, between what is incurred versus what is insured or what is paid. And to understand the sort of interplay between these two, I think we should look at some detail. And if we start with what is insured economic losses, right? So what you see here is a illustration of the insured economic losses worldwide over the last 50 years. And you see that the trend line is slowly creeping up. And some of that is understandable. If you go back to the early parts of the timeline, you see that increase, and that can be explained by advance in the economic activity. So as in any given geography, as the economic activity picks up, the built environment, the value of the built environment goes up, and then whenever an event happens, you see the corresponding impact on the losses, and that trend line is sort of what you see there. Mm-hmm. But if you sort of double-click on the losses, going back to the earlier slide, if you double-click on the losses over the last 10 years, there's an interesting dynamic, right? So the latter 5-year period, the average economic loss in any given year over the last 5 years is almost twice the loss of is twice the annual average in the earlier 5-year period. And this is something that you cannot explain away by the built environment value increase or anything like that. So this is a fundamental interplay between all the different factors, the climate change factors, and some of the perils, the volatility, the increased frequency and severity of the perils that are associated. Now, these losses include both the physical damage as well as the time element, right? But physical damage associated with a given event as well as the time element. But the bottom line is you see that the trend is going up, and given the increased volatility, I think that line is will continue to sort of trend in not the positive direction there. Now, when it comes to the economic losses or uninsured losses, the delta between what is economic versus what is insured is what we call the protection gap, right? And what you see here in the next slide is that illustration of that protection gap. Each bar there represents the quantum or the delta between what is actual incurred economic loss versus what is paid. So the higher the bar is, the greater is the protection gap. And you see that for 2 periods, right? So this is over the last 20 years. So what is unmistakable here is that even the delta, as fast as the insured losses are creeping up, the uninsured losses are going at a faster clip. If you look at US, Canada, you see that the protection gap is almost 2x of what it was in 2001 versus 2020. And over the world, that's gone up by more than 3x, right? So that's the sort of the dynamic you see play here. And here, both the property damage, the physical damage, as well as all the various components of business interruption, both tied to the event as well as the non-damage PI comes into play. And that's really the sort of the dynamic that you're seeing here.
Absolutely. And kind of drilling into the micro impact of this protection gap on housing, for instance, Nicole, how do you see that impact contributing to this overall protection gap?
Yep. So, look, physical risk affects companies, it affects real assets, it affects, there's a multitude of stuff in that bar in US and Canada. A big piece of that is what's happening to US housing stock. So a couple of statistics for you about why we care about this. U.S. housing stock is a over $40 trillion asset class as of end of last year. It's one of the most important sources of wealth accumulation for Americans in the U.S. This is true in other countries as well. And the actual and estimated future losses associated with physical perils is quite meaningful for U.S. houses. We've done some research with one of our partners, CoreLogic, who has a climate risk analytics platform that's focused on the U.S. mortgage market. Based on their data, if you think about kind of current day annual expected losses for the U.S. housing market, it's on the order of $60 billion a year. That equates to about 2% of what consumers spend on housing. It's also roughly 40% of the total amount of billion-dollar losses that are associated with these big weather events that NOAA tracks. So it's pretty significant. It's rising. So 60 million today is going to go up to something like over 70 billion in 2050, and that's actually under the moderate climate risk scenarios that exist in the market, right? All of this is probabilistic, so that's kind of a medium case scenario. A worst case scenario will look much, much worse. And then finally, and this ties to what we were just looking at with Ahmad or with Anil, a lot of the perils are not being fully insured. So flooding is one of the most significant risks associated with real assets like U.S. housing. In the U.S., you are required when you're getting your mortgage to buy insurance if you're in what's called the 100-year floodplains or the special flood hazard areas. The reality is that these maps, which are maintained by FEMA, are quite outdated, and a lot of risk is happening outside of the areas where people are required to get insurance. Roughly, it's about a third of the estimated expected losses from physical climate events from flooding are actually happening outside of the special flood flood hazard areas. So it's really significant and something we all need to be thinking about, because the U.S. housing ecosystem is quite large, right? There's a securitized market, there's a lot of investors. It's more than just banks and their customers. One other thing to layer on top of that, when you think about the dynamics in the U.S., and I think this likely plays out in other parts of the world, is the population growth dynamics that are happening. So it's actually the case that there are many high-risk climate areas, particularly in the southeast of the United States, that are also the places that are witnessing a lot of population growth. So not only are we seeing a rise in the probability of significant climate events happening in different parts of the country and the nature of where those playing out changing, we're also seeing that people are often moving into the places that have some of the highest levels of risk.
That's interesting. And so that's obviously, impact at every individual family level. The other aspect that you mentioned, Anil, was like business interruption contributing to this protection gap, right? Because obviously everybody's focused on just direct damage to assets rather than the value of like the interruption of the business itself. But when we talk about business interruption, it's not just about activities happening within a company. There are a lot of externalities we have to account for, like power feeding into that company, water, roadways leading into that company, et cetera. So Ahmad, how do you account for those externalities in a meaningful way?
Thank you, Dharrini. And as we've heard, right, like the U.S. commercial facilities annually, or at today, are losing up to $100 billion in losses from business interruption. These are uninsured. So this is obviously not an insignificant number. And if you look at the screen right now, this is just an example of a lot of those properties. These are 5 properties. None of them are in the flood zone. You can see the flood zone. It's in the blue, right? So they all get a green report card when they go for their TCFD disclosure, right? Because they're not in the flood zone. They're not going to be in the flood zone in the next 10, 20, 30, 50 years, right? So green report card. But when you actually consider the business impact to the business inside them, we are taking into account things like power outages, supply chain disruptions, transportation, whether their customers and employees are going to be able to show up or not. None of them are anywhere close to green. Literally, all of them are red. And this is the actual loss performance of these commercial properties in the last event. So you can see these properties had millions of dollars in cash flow impairment, uninsured, and there are tens, if not hundreds of thousands of such properties today, every single year, having cash flow impact. Yet, every company which is doing a TCFD disclosure, every company without exception is getting a green report card, because they're just locating their buildings in the flood zone and they get the green report card. But they're not taking into account all these infrastructure which is actually contributing to the business inside these facilities. So really, and quite frankly, I'm not cherry picking these 5 properties. 90% of U.S. commercial properties are not in any high-risk flood zone. That number is in the 99% or higher if you consider just Fortune 1000 facilities. So they get a green report card because it's garbage in, garbage out. But 95% of them have a cash flow impairment even when their facilities are not affected at all. So really, what we are seeing is the risk is in the infrastructure. Right? So we had, quite frankly, our work cut out for us. As I said, otherwise the data is really garbage in, garbage out. So obviously there is no download button where you can download all the world's power infrastructure data, every power line, every water pipe, or every transportation network. No utility has this data. And so what we started to do was, what we do is we use AI to not generate words or essays like ChatGPT or generate images, but we generate infrastructure networks. and essentially starting off with smaller cities with real data from a handful of cities, we were able to then train models, use foundation models and machine learning and artificial intelligence to be able to then validate our first ever model for basically entire nations, where we were able to basically synthesize the infrastructure grid, power, transportation, etc., for the United States. Now that we have something like that capability, what do you do with it? You hit it with any sort of disturbance. Something happening in the next 20 minutes or 3 days, like a hurricane, or something happening over the next 20 years. And you are able to now see those ripple effects propagate through that graph for the first time. And you are able to quantify cash flow impairment to any of these businesses due to their supply chains being impacted, due to their power outages. We had a month-long power outage in several areas last year due to hurricanes. This is just a glimpse of sort of the data which we are now seeing. So, on the left, so these are, 5,000 commercial mortgages, in the Miami region, where we are considering flood and wind impact. This is over a 5-year period. So, on the left side, if you consider just the direct flood impact to those properties, and you are basically plotting here the probability of default. So on the left side is the rosy picture, right, where you're basically sort of like, hey, not really, like 95% of them actually are less than 5% probability of default, so not really a big problem. And the extreme left is actually without considering climate change, so backward looking, and then the second one, green one, is considering climate change. But now if you try to incorporate the impacts of infrastructure, in this case power and transportation, to those businesses, you start to actually uncover a lot of defaults because of business interruption, because of power outages, and really, this is like, this panel is called the ticking economic time bomb. This is the ticking economic time bomb, right? We are going to see a lot of these defaults because a lot of these securities are in some of these financial institutions. So
I guess switching to a slightly cheerier mood. And I'd like to, present this question to each of you, maybe starting with you, Anil. What is one development in recent years that makes you the most optimistic about our industry's ability to tackle climate financial risk?
Sure. So when it comes to, we're talking about impact to the physical risk and how you model, all the different loss scenarios, right? So, and in that context, when it comes to physical damage to a property, there's a fair degree of sophistication, and that part's well understood. And you see all the different tools and techniques applied that make it, fairly sophisticated in terms of our ability to understand. But when it comes to the notion of BI, it's still, a lot of this analysis is done on heuristics and factors and things like that. So that sort of is the state of play. But what is exciting is the application of forward-looking models, especially when you're kind of thinking about climate change, where there is inherent volatility in both the frequency and severity of some of these perils. You cannot look back and base your models on historical claims, because those are always going to be underperforming the actual events. And so that's where some of the developments and advances, things that Ahmad talked about, application of AI and usage of this AI in building forward-looking models to understand all the different scenarios. I think that's a pretty a fascinating and a positive development. And what's even more interesting is now you have different regulatory bodies also allowing usage of such techniques when it comes to quantifying the impact of all of these factors. So for me, that's the exciting development that I'm looking forward to.
What about you, Nicole?
I mean, yeah, second, analytics. I mean, maybe kind of looped into that is just some of the entrepreneurialism and innovation we're seeing in the kind of climate tech space, or whatever you want to call it. So, what Ahmad's trying to build, what CoreLogic's trying to build. There's so many companies out there who are trying to really think about how do we bring data and analytics and AI to help us uncover a better view of the risks we're facing. I think the other one I would call out is just the role that the government is trying to play in these different spaces. So, the Inflation Reduction Act we often think of as being really driving kind of the transition side of the story, but there are elements of that are also kind of tied back into adaptation and resiliency financing, which is really important because some of these risks are going to stick around and we're not all going to move. So we need to figure out ways that we're also, once we understand the challenges, actually trying to mitigate them.
And you, Ahmad?
Yeah, I mean, I think as Nicole and Anil said, we wouldn't have been able to do this a few years back if we didn't have the ability to use sophisticated models, capture this data. We started doing this for like small cities and small neighborhoods first, because it would take us, like weeks to months to just go and beg the city government to collect this data. The water department, the power department, the utilities didn't really have all data. Now with AI, with foundation models, we are able to actually, leverage those techniques to understand this impact at a much deeper level. And I feel like also at some level, I do see some of the regulatory international bodies, multilateral organizations kind of speaking about this. I do hope that more institutions, especially regulatory bodies, kind of wake up to this, because this is a systemic risk, and it's no longer a good to have thing. This is not like a good to capture kind of data or disclose data. This is what we are seeing right now is it is extremely material. So we are going to have how many more utility companies going bankrupt, or many insurance or other companies going bankrupt is it going to take, right, for people to wake up, really. So because we are already seeing that in the data. We've already seen that happen, but we are seeing that, so yeah, I'm excited by, some of the partners, some of the early adopters we are seeing in the market, because they are thinking about it the right way.
Yeah, I think that's an important point on like regulatory mandates or accountability for the industry overall, right? So coming back to you, Nicole, what do you think needs to happen from here on for us to see a higher level of adoption for like climate financial risk disclosure or assessment even?
Look, I think a lot of the pieces are there. So I'm most familiar with the banking industry. Regulators globally, including in the US, are putting a lot of focus on physical and transition risk assessment and doing that well. Now, they don't know how to do it either, right? So it's not like we all know the answer and people just are not doing it, right? We're all building this together in terms of really understanding how to model and measure these things. So it's going to take time, but I do think the regulators are focusing on this, and I think they should. The goal is consistency of focus, right? Like, let's not drop this and start to think about other elements that matter for the financial system, because it is a systemic risk and it's only growing and it's kind of hidden. So I think that's a big piece. I think investors continue to play a role in asking the companies that they're investing in to provide this level of disclosure and information, right? I think those are two really important pieces of it.
Yeah. How about you, Anil? And anything else that you think would need to happen?
I think when you are on the risk transfer side, right, so this all becomes real. Right. And there is an element of risk, somebody is seeding, and if you're packing that or you're engineering that risk transfer you're putting your capital at risk, right? So I think so this is one of those scenarios where I would expect to see faster adoption of some of these areas, regardless of what labels we apply. The impact is here and now, and you start seeing that reflected in the pricing of some of these exchanges, and that's only going to be more sophisticated with the advent of more techniques, right? So clearly all the disclosure requirements and all of that would be super helpful, and they will all contribute to advancing it. And as Nicole said, this is an answer we're collectively sort of deriving as we go. But I think from a risk transfer vantage point, there is an immediacy. It needs to be factored in today, because that's what impacts the bottom line.
Right, absolutely. Thank you for all of your valuable insights. Abby, maybe we have some questions from the audience.
Hello, yes, we do have a question from the audience. Given the complexity of climate modeling and the rising cost of working with external service providers to interpret that risk, how do we democratize access to climate risks for individuals, small and mid-sized businesses, marginalized communities, et cetera? What role does the private sector have to play?
Ahmad, do you want to take this one?
Yeah, I mean, this is a great question. I think we are seeing some of the FEMA maps, for instance, right, like being available to the broader public. Obviously, those maps don't seem to. I mean, they're two-dimensional, so obviously they don't capture some of these ripple effects. So I feel like people like discovery of risk and being aware of your risk is step one. And in fact, we are starting to see financial institutions, large financial institutions, and reinsurance companies being very open to making this data available to their customer base, because quite frankly they have their own incentives. They can basically then sell some financial products on top of it, but at least that gets the risk. We call it project data ubiquity within one concern, but it is an extremely important thing, because unless people are aware of this risk, that's the bottom line. That's where it starts. And quite frankly, right now we can't hide behind this thing saying like, oh, we couldn't capture this risk, the data is not there. No, we have consistent, comparable data to link physical risk and capture 90% of cash flow impact today because of climate risk to any business in the US. So we can't obviously say that the data is not available and it's really digital, so you can get access to it. If a hedge fund can get access to it, then quite frankly anyone should be able to get access to it. We obviously see on the other end of the spectrum, 40 to 60% of small businesses don't reopen after a disaster, right? We see, in fact, for the ones which opened, 25% of them shut down after a year. So there is an outsized impact to marginalized communities. There is, we see, like it's kind of filling like a bathtub with water. The bottom of the bathtub is the US power grid. So that's why you have like week-long, month-long power outages now. We didn't really have that 20 years back. That's climate risk for you. So then you keep filling it up, then you have the water system. Then you have the transportation networks. Then you have like, quite frankly, like the blue-collar workers in Houston, their homes, they get affected. Then way up is the corporate facility or the Fortune 500 facility. They don't get affected directly as much as the marginalized communities or the infrastructure. So I definitely feel like, this could be a public-private initiative where we could come together and actually distribute this data more broadly.
Absolutely. Nicole, Anil?
Only thing, so totally agree. I do think it's more than a private sector problem for the reasons you're highlighting, right? Like there's some big public good problems we're also trying to solve, so we need to think about it more in a public-private vein. And then the other thing I'd say is like it's about the packaging of the information, right? Because a small business also isn't going to be doing a sophisticated analysis with like data dump, right? So it's more about, I think the opportunity for financial services providers is understanding you want to help your customer make better decisions, which is going to improve the risk profile of what you're doing with that customer, and how are you communicating it in the way that's going to be most consumable by that audience.
Wonderful.
Yeah, in fact, just to add to Nicole's point, there was a day when we had metrics like, hey, you're telling a bagel shop owner, you are in a 500-year flood zone. What is the bagel shop owner supposed to do with it? They don't know whether to like cry, laugh, run away, sell their property, or just stay put. They're like, I'm not going to survive for 500 years, because they don't really know what it really means. But now you can tell them, that, hey, over the next 1 year, there's going to be 3 days of power outage and 10 days of no foot traffic. That's actionable information to literally that bagel shop owner, or to any sort of financial asset tied to that hard asset. They can do something about it. They can mitigate it. They can probably put solar and a sustainable battery, and mitigate that risk, right? And probably accelerate their net zero footprint. So essentially, there are ways to make it a win-win situation between the public and the private sector.
Yeah, I mean, I think Nicole and Ahmad touched on this, right? So as appealing as it sounds, access to all the data, and an individual is not going to be able to tap in and do these sorts of analysis, right? Ultimately, it comes down to how do you enable these insights, and how do you provide actionable, mitigation measures, and that's only possible through private-public partnership. And I think that's where I would say most of the value is going to be in terms of driving this forward.
From your mouth to every central bank's ears. So, thank you, Nicole, Anil, Ahmad. Thank you, everyone, for joining us today.
Thank you.